Hey guys, what's up? Alec back with the daily stock market, and look at that, another powerful green day today. My account is up around 25% just in the last week. So is the rally here to stay, or is this another dead cat bounce? Let's dive into it. Make sure you subscribe with post notifications on. Lots of stocks up 13, 12, 10, 9% on the day. Let me know if you want me to add any stocks to this watch list. Comment below if you don't see a stock that you want constant updates on. In this video, we're going to talk about a few different stocks. We're going to do rapid fire on some, and some of the stocks we're actually going to do a deeper dive in. So make sure you stay to the end if you want a full update on a bunch of different stocks. So first one that we're going to talk about is Nvidia, down 14% in the last 52 weeks with an all-time high of $330 per share. Okay, we see a good support right around $150 per share to $125 per share, which is where I want to be buying Nvidia a little bit heavier. Now, in my opinion, this could be a dead cat bounce, meaning that we have further down to go in the stock market, and stocks are just not going to be up only from here. Okay, we've seen a good week in the past, a good previous week we've had in the stock market with lots of green, but I think there's still some strong supports that Nvidia has to hit, that Apple has to hit, that SPY has to hit. So make sure you're watching some of those big tech stocks and the S&P 500 and the NASDAQ as well. We haven't talked about Google in a while, and I know you guys have been asking me to talk about them. So let's go ahead and just do a quick update on Google. We won't spend too much time on them. We see a support around $2,100 per share, currently at a 52-week low. And we see there is no really strong supports for Google. They've just been consistently making gains in the last 5 years. Their rolling averages is very good. And they're only down around 25% from highs. You know, like some of these other companies are down 60%, 40%. So something like Google could still have a ways to sell off, closer to $1,700 per share. $1,400 per share, I think, is probably the lowest that we'll see Google. So I have price alerts set at $1,400, $1,700, $1,800 per share, where I'll buy larger amounts. Remember, there's also some rumors that Google's going to be doing a stock split sometime soon as well. Now let's talk about Alibaba for a little bit, up 6% on the day, ticker symbol BABA. You can also see there's this new tag up here with information, ADR. What is an ADR? American Depository Receipts. Represented shares of non-US based companies. Banks issue ADRs to facilitate trading on U.S. stock exchange. Some banks require investors to pay a periodic service fee, typically 1 to 3 cents per share. And if you want to learn more, you can actually click learn more and learn more about those. And you can even pause the article and read more about them as well. But overall, it's nothing big or extremely worrisome to worry about. I'm talking about 1 to 3 cents per share on extra fees for a non-US based company. This is a stock, if it gets to new all-time highs again, it could hit a 300% gain. But let's dive a little bit deeper to see what we think about Alibaba. Okay, on the annual basis, you can see their net income has been all over the place, not growing consistently, and it's down to only $32 billion in net income. And in 2020, we even seen them as high as $150 billion in net income. Now we see their total revenue higher than it's ever been, up to $850 billion in revenue. So the question is, if they were in 2020, if they were doing $500 billion in revenue and they were getting $150 billion in net income from that $500 billion in total revenue, then how come in 2022 they're doing $850 billion and they're doing less revenue? They're only doing $32 billion in net income. So that's a little bit interesting, a little bit concerning. Quarterly, they're keeping up with their total revenue, and their net income looks very sparse. They have an excellent balance sheet, so they're a relatively safe company out of all the other Chinese stocks for long term. And if we look at some value metrics, we can see that the PB ratio on BABA is 1.9. The PS ratio is 2.2, which is relatively low, especially for the industry, the tech industry that they are in. PE ratio is 31, and the forward PE is 15. We'll go on to read some summaries. Alibaba is an excellent and leading high-tech company, fairly called the Amazon of China. This big brand was growing for many years, with Alibaba stockholders facing very high sales and profit growth, which we already looked into. The company's stock, however, started facing a significant downturn due to COVID-related lockdowns and the situation around Ukraine, but most importantly, due to regulatory pressures. Some of these factors do not pose any significant threat to the company right now. At the moment, the stock is undervalued, but I would not jump in just yet since the global economy is still at risk. We'll go on to read that Alibaba's chief rival JD.com is facing headwinds, which should give Alibaba an edge over the long term. Alibaba's fundamental performance is much better than JD in terms of revenue, margins, and economic moat. Tencent has announced that it will divest its 17% stake in JD in order to prevent any antitrust issues, and could also limit its operational partnership with JD. International expansion by Alibaba should allow the company to weather any future regulatory issues in China. Alibaba is trading at a massive discount in terms of forward PE ratio compared to JD, which makes it seem like a better bet among the Chinese stocks. Some main risks to consider. The main risk, in my view, is the risk of a global full-scale recession in many countries, including US and Europe. Central banks are now tightening the monetary conditions, which, as many analysts say, is highly likely to provoke an economic downturn. The demand for Alibaba's goods certainly depend on consumers' income, since the company does not just sell necessities. Although most of Baba's customers are based in China, the country's well-being largely depends on other countries because China is an export-oriented economy. There is also a chance that the Chinese government may further tighten its anti-monopoly regulations. Since the Chinese government also wants competition, it might try to take the economic conditions more favorable for smaller companies. These could in turn become rivals to Alibaba. Large-scale companies become very popular since they get controlled over their users' data, which people often write off and act like it's not important, even though it's extremely important. Many governments, including China, try to limit this power by passing tougher regulations and disciplining companies that fail to comply. Conclusion: surely Alibaba stock is undervalued and is issued by a leading company, but in my view, there are too many external risks surrounding the stock. The most important one, in my view, is a global risk of recession, which would be sustainably affect China also. Although I consider Alibaba a steal at these prices, I would not personally jump in. In other words, Alibaba stock would make sense during a full-scale recession when the stock market further crashes overall. Now, if we look at what analysts have to say, we see a 43% upside to $161 per share in the next 12 months if you want to take the risks. We have some analysts with above $200 price targets for Alibaba, and these are some 5-star analysts. As you can see, some are from Bank of America. Personally, I'm waiting for more of a downfall also, even though we're at a 5-year low basically on Alibaba. I want to see them closer to that $85 mark or even under $90 per share for me to start buying in Alibaba. I think under $90 per share, that's when the risk versus reward starts becoming a lot more attractive. And make sure you subscribe with post notifications on, because we're going to talk about recession-based stocks in future videos. What are the best stocks to own during a recession? What are stocks that people have to buy, like the diapers, the makeups, the toilet paper? People still buy that stuff in a recession. Toothbrushes, toothpaste. Talk about the best companies to own that are also dividend stocks like Johnson & Johnson and PG, and if they're good deals on the stock market. So make sure you subscribe with post notifications on if you want to see that and if you're excited about that. Now let's talk about Visa, because Visa is going to be an interesting one as well. So they're down 16% in the past year to a 52-week low. So I think they also still have more to drop when people spend less on their credit cards or their debit cards. They make less money from fees and everything. So I think under $150 and I think closer to $150 per share is definitely possible. They can also go back to like 215 because they have a lot of short-term action between 215 and 190 and $231 per share. So with that being said, if they do go up to a $215 per share again, I'm thinking about doing a put on them from 215 down to around $109 per share, shorting Visa and making some money in the short term. So there's a little gem for you guys if you watch this far in the video. If Visa gets to around 210 to 215, I will be taking out a little put there, and I'm going to be posting that on the close friends list when that happens. Analysts have a 36% upside on Visa in the next 12 months to $267 per share. Right now, Visa is $196 per share. Even the lowest analyst has a $235 price target in the next 12 months. So that could be something strong to consider. Analysts see a lot of potential in the stock, and we don't have any analysts with a price target below $235 per share for the next 12 months. Now, you might want to take this with a grain of salt because a lot of these predictions were made in the past month, although Visa hasn't moved too much in the past 1 to 2 months like some of these other stocks have. Now, analysts love the stock, so you don't want to short them long term. It's just going to be a quick little thing because they move pretty quick in that short term range that we looked at. So a summary on Visa: has many more transactions and higher payment volume than many of the fintech disruptors. The slowdown of e-commerce will harm the fintech disruptors more than Visa, and the company will benefit from the return to in-store sales. Inflation is not as harmful as many investors may believe and can actually be helpful to the company's top line of Visa. Now, Visa versus Mastercard are two of the greatest dividend growth story stocks in history, delivering 24 to 32% income growth over the last 14 years. They've beaten the market 3 to 5x and even put the NASDAQ returns to shame. Today, the bear markets have brought both companies down to attractive valuations, making them as close to perfect hyper-growth dividend opportunities that exist on Wall Street. Visa offers slightly higher profitability and slightly better valuation, resulting in slightly higher short-term returns. But Mastercard's 7% faster growth rate makes it my choice between the two, with potentially to 3x in the next 5 years and double Visa's returns over the next decade. The 2022 bear market has been devastating for some of the hottest tech names in the pandemic. So just to review, we can see that Penn National from the bottom of 2020 up to the top, 1,290% gain, and from all-time highs down 76%. And we can see this going all the way down with around 20 different stocks. So if you want to pause the video and reflect on that, feel free to. Mastercard and Visa have both delivered 2 to 2 times the inflation-adjusted returns of the NASDAQ and 3 to 4 times higher real returns than the S&P 500. And as far as dividend goes, it's hard to find a more impressive growth rates. 24 to 32% dividend growth rates over the last 12 years is absolutely stunning, turning a modest 0.3% to a 0.7% yield in 2009 into potentially life-changing 8% to 9% yields on cost in 2021. Okay, reasons to potentially buy Visa today. If you're seriously considering it, I would pause the video now so you can actually do some of your own due diligence and read every single one of these bullet points. But just to name a few, it's the 99 percentile's best company, ranked 5th highest, 100% dividend safety score, 14-year dividend growth streak every single year since IPO, and so on and so forth. Like 0% bankruptcy risks. Visa 2024 consensus total return potential. Here you can see the growth is expected to continue for Visa. Now, if you want to pause it and read through all this information, I highly recommend it, but I just don't want to drag the video out too long. For anyone uncomfortable with its risk portfolio, Visa is as close to a perfect hyper growth ultra swan dividend growth opportunity. If you don't know what the ultra swan is, that's basically like another name for blue chip stocks. 9% discount first 3% market premium equal 12% better valuation, much higher quality and far superior dividend safety, 70% higher long-term return potential than the S&P 500 over time. So there's a 70% chance that Visa and Mastercard will give you a better return than the S&P 500 will over time. About 2x better risk-adjusted expected returns over the next 5 years as well. Now, that's actually for Visa. If you want to jump into Mastercard also, pause the video, read all this stuff about Mastercard, and at the end of this article, you can see a bottom line. Both Visa and Mastercard can help you retire rich, but Mastercard is slightly better to buy today in this analyst's opinion. If you can afford to buy both companies, thanks to fractional share and commission-free trading, it's a great idea to do so. Owning either company is not about immediate income, but maximizing long-term dividend income and wealth. And when it comes to hyper growth, both Visa and Mastercard have incredibly long growth runways ahead of them. You can't go wrong with either of them in terms of quality, safety, fortress balance sheet, long-term risk management, and long-term dividend growth potential. But ultimately, Mastercard is a much faster growing company, and over the next 10 years, that could result in a 2x better returns for Mastercard shareholders, who are likely to see much faster dividend growth as well. So that's why Mastercard is a higher priority ultra growth swan stock in the bear market. I can't promise you that either company will make you money in the short term, especially if the market isn't done selling off. Citigroup and Morgan Stanley think the market isn't done bottoming yet. But what I can say with 80% confidence is that anyone buying Visa Mastercard today is likely to be pleased with the results in the next 5+ years, and potentially euphoric in the next 10+ years. So overall, Visa and Mastercard are stocks that I am dollar cost averaging in. I'm just looking for a bigger fall. Okay, I want like a more 20% more downward movement before I start really loading up on Visa and Mastercard, because in my opinion, I don't think the market is done bottoming yet. We can short it in the meantime. Look at all this short-term movement that Visa and Mastercard both have. They both shoot up around 10 to 15% in the span of a few months, and then they continue to sell off around 15% after that. So can they break past the 52-week supports and go closer to a 2-year support, or a 2-year low, or a 3-year low? So that's what I'm really looking out for. Also, dollar cost averaging for long term, because I do believe that Mastercard and Visa will continue to be around for the next 10 years and continue to grow over time. So smash a big thumbs up on this video, subscribe with post notifications on so you don't miss any future content just like this when we dive into stocks, and share this video with a friend if you think that they can find it helpful as well and there were some true gems and value pack on this video. If you want more consistent updates and see exactly when I'm loading up on stocks, what price alerts I'm buying in at, what price alerts I'm selling at, what stocks I'm buying, option trading. If you want to become better at option trading as well, I have a close friends program that shows you what options I'm buying, what stocks I'm buying. I even have a video step-by-step program for beginners on how to trade options from zero to expert, and also just the stock market if you want to become better at long-term investing, how to value a company. fundamental investing, so on and so forth, technical investing. Message me on Instagram so we can put a plan together that's going to best fit for you. We'll go over if you're a short-term investor or long-term investor, option trader, or if you're all of them in one, and then we can bundle up a nice custom package for you. I'll shoot you over my website so you can see how everything works. All right, guys, remember to always be buying low and selling high. I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.